Hey folks, hope you had a good weekend and well rested and relaxed. And we're starting up on new content today. But before we get started, I have a few announcements. So one thing that I mentioned at the beginning of the semester that we haven't really talked about, we need to talk about, is the end of semester presentations. And we have 15 people that are in person for this course. And so I'd like to do 3 groups of 5 if possible. We need to start settling on those group assignments as well as the presentation topics. So please start thinking about that. Yeah, I'm definitely going to take the 6 of you right there and split you 3-3. That's exactly what my plan is. I'm just going to roll dice, and there's going to be whoever's in one group of 3 and there's another group of 3. You know, that's my plan. That's my plan right there. It doesn't even matter if you petition me saying we want to be a group of 5 and abandon one of you. It's just going to be 3-3. I think that's the easiest way to chop the Gordian knot. Yeah. You're not gonna throw poor Jared under the bus because he's not here today. Yeah. This will be Brett. Yeah. I don't know. Yeah. Jared is ill today, so yeah. And I'm recording this, so it's gonna be on YouTube for all time. So yeah. But no, he emailed me earlier today. So please start thinking about that, and also start thinking about the presentation topics. Those are listed in the syllabus. Some of them are more fun than others. It's first come, first serve. I'm not saying that you should pick a fun one. I'm just saying that if you want one of the fun ones, you probably should pick that earlier rather than later. I think there's some that are very important and interesting to talk about, so we can have that discussion as well. Also, this came across my email. It's not been sent out to my knowledge, but for those of you who are interested in forensics, the ACFE actually has a big scholarship coming out for 2025, 2026 called the Richie Jennings Memorial Scholarship. Basically, the criteria are down here. You can go to the ACFE website to see the eligibility criteria, but it's declared major or minor in accounting, business administration, finance, criminal justice, and you have to be enrolled for next fiscal year, or next school year, 2025, 26, and be at least in the second half of your sophomore year, which everybody in this room is well beyond that point. So something to consider. I believe it's still available for graduate students if those are your undergraduate program, or if you're going to be here for your final year next year. Either one, it's a neat or interesting opportunity that I don't think has been talked about. All right. Today we're going to start chapter 6. Before we start chapter 6, the discussion case that we'll be doing on Wednesday. Close the door real quick. I'm all for people having fun, but not when it comes to the expense of my class. All right. Which is why we have 0 fun in this class. Is 0 fun. All right. So the case that we're going to be talking about for our discussion on Wednesday is going to be the second part of the cost case. Remember costs from chapter 4? The lady who stole $34 million, you know. We're going to talk a little bit more about controls failures in there. And so please make sure you read that and are prepared to discuss. There's also, for the homework, there's a question about the fraud that occurred in Dixon County, Illinois. That one's actually an interesting one, as there was a documentary created about it. It's actually called All the Queen's Horses. It's free. You can find it on YouTube. You can find it on IMDb video. I think Amazon also has it. You do have to watch commercials with it, but it's still pretty interesting. I know that you all don't have a lot of free time, but if you find yourself kind of interesting in something intellectual and related to this course, you might check that out because it's fascinating, and it definitely will make you shake your head and say, what the heck just happened? You know, it's kind of unbelievable. I said Dixon County. I think city of Dixon. I make that mistake every single time. I say Dixon County, and it's actually the city of Dixon, Illinois. I don't know what's up. Yeah, that's the problem with getting old. Today, chapter 6. Let's get going before I dig a bigger hole for myself. I want to talk a little bit about New York restaurants. So I know that doesn't seem like it's relevant, but bear with me because we're actually going to get to the relevance here in just a second. So this is a fairly famous, well-known pizzeria in on the island of Manhattan. It's called Lenny's Pizza. Has anybody ever had Lenny's Pizza? That's has anybody ever had New York pizza? Does anybody have strong preferences about New York pizza versus Chicago style pizza? There's like a big Jon Stewart tirade where he talks about that on the Daily Show, but you got a preference. I like both. I just like pizza. I'm a big fan of food in general, but going to New York and getting to try New York style pizza from actual New York's good. And Lenny's one of those places that does it very well. The reason I brought this picture up is that This is kind of a typical storefront because Lenny's is a chain in New York. And if you look at their storefront, they've got a whole bunch of stuff in here. It's just very basic, but they've got this A centered in the window, okay? And that A is kind of what you would think it would be. It's a sign of quality, okay? It's a sign of quality. But what specifically is the quality referring to with respect to that letter? Does anybody know? Yeah, it's health inspector. So they actually are required in the state of New York to publish their health inspection ratings on a sign on the door. And it's basically a graded system, A, B, C, and then F. They don't have a D. It's like if you get below a C, you're not opening up. And so that's kind of the way that they use the system. Presumably, you want to go to a restaurant that's an A because A means that they've met all the health inspector criteria and you're not going to get sick by eating at the restaurant. That's the assumption. So it's a signal. It's an important piece of information because it tells you about the process by which you're getting the food. Doesn't matter, again, if the food is delicious. You want to know, is the process by which this food is prepared, is it going to be something I would approve of or not approve of? And so that's the signal that's being sent here. Now, the reason that relates is that we're going to be talking about controls today. And if you remember when we talked about this back in chapter 1 very briefly, I said controls represent the process by which transactions go into the financial statements. And it is just as we talked about back in 367, controls represent a response to a risk. Transactions go through a system, and the way that the transactions are processed go through a series of checks. These checks are controls to make sure that everything is being met properly. So let's talk a little bit about the origins of where internal controls come from and the framework that we currently use to consider controls. Now, I do want to clarify, we're going to go through some basic information about controls. Some of this is going to be repetitive. Some of you are going to say, you talked about this in 367, Dr. Barnes, and because I was such a big fan of COSO back then, I retained everything you said. And if that's the case, then good job, okay? I appreciate you retaining every single thing you said. It's just really important to remember every word I said because it's very, very critical. I'm obviously being facetious. I'm assuming that we're going to be starting back on trying to remember some of the important stuff. Also, with respect to controls in this course, obviously understanding the nature of controls is important, but our job as auditors is to actually test those controls. So we're going to be talking about an ancillary step that's really, really important. Okay, so first thing, we're going to be talking about the COSO Internal Control Integrated Framework, which we've already discussed before. So let's just take a quick look. And I don't think I did this back in AIS, so it's something that we can take a look at. So COSO actually has its own website, and this is the COSO website that talks a little bit about their initiatives that are in place. Now, COSO stands for the Committee of Sponsoring Organizations, and you're probably thinking to yourself, that's really interesting, Dr. Barnes. I'd really like to know more about what organizations are sponsoring this. Well, in fact, if you scroll down to the front page, it tells you these are the organizations that actually sponsor. So some of these you probably recognize: AICPA, Institute of Internal Auditors, Financial Executives International, IMA, Dr. Otero's Stomping Grounds, the Institute of Management Accountants. You may not be familiar with this one. This is the American Accounting Association. It's not the AAA automotive group. It's actually the AAA. This is the academic group. Okay, so anybody in my position is a member of the AAA, and that's what we think of. Which would be nice if we could actually get them to handle our automotive emergencies as well. But apparently, you have to go through a different AAA to do that. So yeah, the sponsoring organizations. And what are these organizations sponsoring? Well, back in 1985, they were starting to notice the beginnings of corporate fraud that were occurring in organizations. And they said, we need to have a committee put together to figure out how we can best address corporate fraud problems that are existing. And if you've ever seen the old Michael Douglas movie, Wall Street, you can kind of see all of the issues that were going on in corporations back at that time. It's a lot like corporations nowadays, except there were very few checks or balances on the activities of those organizations, and auditing was not nearly as rigorous or regimented. So that was kind of their goal, and they came up with the idea that if we're going to have this, it was called the National Commission on Fraudulent Financial Reporting. You don't need to remember this, by the way. I'm not going to test you on this. They were actually, that was the technical term, but it was called the Treadway Commission. And basically, all these organizations came together and said, we need to have more established guidelines for the implementation of internal controls. And in 1992, they came up with a set of standards called the COSO Internal Control Integrated Framework. Now, we've since updated the framework. It's now, I believe, on COSO 2013 is the one we're operating on. So it's still 11 years old, but 92 was the beginning of this. And so what is the responsibilities that we're talking about with respect to these internal controls? Well, we already know some of this already. This is what we alluded to already in this course. Management's responsible for the design, and maintenance of internal controls. You might actually throw in their implementation as well, because that's another one of their responsibilities. So they've got to design controls for their organization. They've got to implement those controls and then over time maintain them to make sure they're properly operating. So that's management's responsibility. And that in a nutshell is what we talked about in 367 with respect to controls. We talked about how do we create controls in an organization. But the auditor has a different responsibility in this area. They're responsible for understanding and assessing the performance of internal controls. So management creates the controls. We as auditors go in and we try to say, all right, I need to understand what the controls are doing. And then if necessary, we'll talk about when that if necessary comes up. If necessary, testing those controls to make sure that they're operating effectively and designed properly. All right, so let's go ahead and get into the internal control framework. This is going to be a review of some of the things that you already know. So remember, back when we talked about COSO has 3 overarching objectives: reliability of financial reporting, effectiveness and efficiency of operations, and compliance with laws and regulations. Now, right now, we're going to talk about these at a very general level. But in Chapter 7, we're going to drill down into one of these because one of these is more important than the others with respect to financial statement audits. Can anybody guess which one of these 3 is the most important with respect to financial statement audits? I'll give you a hint. Financial statements are also called financial reports, okay? Which one do you guys think? Did you say reporting? Wow, that was really loud and deafening. Yeah, okay. Yeah, it's reporting, okay? Reporting. And so we're going to talk about controls specifically in that area. They're going to be internal controls over financial reporting, ICFR, all right? And we're also going to talk about the components because I'm a big fan of talking about the components of internal control. And if you're wondering, will I ask you questions again? Since you asked him in AIS, you can't ask him again, Dr. Barnes. That's cheating. I said, well, I am beyond the scope of cheating because I teach the class. All right. So will I ask you questions about the components of internal controls? The answer is you betcha. 100% chance. So this is something we're going to have to refer to. So the most relevant internal controls in a financial statement audit are those that contribute to the reliability, timeliness, and transparency of external financial reporting, which we just talked about. These controls are relevant to audit because they help to prevent or to detect and correct material misstatements in these financial statements. So this is, again, something we alluded to back in 367. We talked a little bit about the nature of internal controls. And remember, controls do one of 2 things. They either prevent a problem from ever occurring, or if a problem does occur, they detect it and fix it. So that's kind of the nature of controls we talked about here. 3 categories of controls: preventative, detective, and corrective. And detective and corrective are usually paired together because they naturally work with one another. So that's how we consider controls. External auditors for larger public companies are required to express an opinion as the effectiveness of the client's internal control over financial reporting, which we will talk about specifically in Chapter 7. We're going to go over the big picture stuff in this chapter, and then we're going to talk about a little bit more detailed stuff in Chapter 7 with respect to this. It's important to note that organizations that are not public companies, they still do have internal controls over financial reporting. It's only the requirement for companies that are listed under Sarbanes-Oxley Act that they actually have to have this reporting performed, which creates some tension because we're not sure if we have to test controls or not. But we'll talk about the scenarios in which we do and do not test controls in just a second. Right now, we're going to be doing a refresher. We've got our components of internal controls: control environment, entities risk assessment, control activities, information communication, and monitoring activities. Hopefully you remember them. Hopefully you love them. And if you don't love them, learn to love them because this is really, really important stuff. So COSO framework says 5 components. There are also 17 principles that go along with these components. And I will tell you right now, for those of you who thought my AIS class was hard, the previous AIS professor actually made you memorize all 17 of those principles as well. Okay. If you want to do that on your free time, that's absolutely fine, okay? But I think that this is probably enough. A good conceptual understanding of these is very important for any accounting course. I think that for this one in particular. So let's talk about them. The control environment. Control environment sets the tone of the organization, influencing the control consciousness of its people. So the importance of control of the entity is reflected in the overall attitude, awareness, and actions of the board of directors, management, and owners regarding internal control. What does that all mean? It basically means however serious management takes controls is how it's going to be reflected throughout the organization. And you can think about that through a pretty simple scenario, all right? We just had an exam, and you saw me during the exam. For the most part, I mean, I will say there were a few times that I looked down at my iPad because I was checking email and doing some other stuff going on, and every single time I seemed to look at my iPad, the hand went up, okay? I would say it was a conspiracy, if anything else, but the hands were going up like right as I was looking down, but I was looking at most of the time. So I say I take the controls in this course pretty seriously, particularly with respect to cheating. And you know, I review the homework, and if anybody's like putting in the homework that's consistent with somebody else's, like identical answers, I say, "Are you guys working together, or is somebody copying off the other?" I'm taking it pretty seriously. Okay, that's my control consciousness for this course. What if you said, "Hey, Dr. Barnes, can we bring notes in for the exam?" And I'm like, "I don't care. I don't care. I'm ready to retire. Okay, I'm tired." Yeah. Can we copy off each other's homework? Sure, whatever. Just as long as you do homework. Dr. Caden makes me do it anyway. Yeah. That's a lot different attitude, much different attitude. Now you may say, well, I kind of like the second Dr. Barnes a little bit more. But then again, the second Dr. Barnes is probably not too focused on trying to teach you auditing as well. You probably won't learn as much in that scenario. So there's a reason why control environment is so important. If you go into an organization where the people at the top don't really care about controls, okay? There have been a few organizations in history like that. There's this Enron company that I keep bringing up, all right? Not a real big focus on controls for that particular entity. What happens? Well, the entire organizational structure kind of collapses because they do not have the proper tone within the organization to address problems. So in my opinion, this is the most important component of internal controls. And you've asked, will I test you on that? I may ask that test question. What does Dr. Barnes think is the most important component of internal controls? And you're gonna say, oh, that was the one at the top. Then you have to remember which one it is. All right, so this one's kind of the overarching one. This is kind of affects all of the other components of internal control. But then we start talking about a sequential process. We know that we have to assess risk. The entity has assessed risk. Why? Well, a control is effectively a response to a risk. So if we're going to create a control, we have to know what risks we're going to create a control to address. So entity's risk assessment process identifies the response to business risk and relating to achieving business objectives. So we're going to identify the relevant risks, estimate their significance, assess the likelihood of occurrence, and decide how to manage the risks. One thing we're going to learn in chapter 7 is that there is an innate process for evaluating significance, because we're going to consider controls on multiple dimensions. It's great when we identify a risk, because then we know we have to respond, but we also need to take other factors in consideration, okay? So for example, my controls that I put in place over an exam are a lot different than a control that I put in place over homework. One is worth 60 points, one is worth 5 points. If you cheat on a homework assignment, that's not a good idea, but I'm not really thinking the sky is falling. If I find cheating on an exam, that's when I take things really seriously. So significance is going to be something that we have to consider as part of that. Generally, we're going to consider both likelihood and magnitude. You don't need to worry about that. We'll talk more about that next week, but keep in mind that this is kind of a quantitative process as well as a qualitative process. In addition, we note that once we identify risks, that we have to actually put controls in place. What are those controls called? They are control activities. You knew the car was coming. You just knew the car was coming, didn't you guys? Okay. If you guys are looking at that, so I don't remember what the car is. Shame on you. Okay. Shame on you. But the good news is you'll remember after I explain it. So the policies and procedures that help ensure managers and directors are carried out and implemented to address the risk identified in risk assessment. What are some examples? Controls are going to be like approvals, authorizations, verifications, reconciliations, reviews of operating performance. You know, like when you go to work and they say, okay, it's time for your monthly review or your quarterly review, and they tell you what you're doing right and tell you what you're doing wrong. That's not there to make sure that that you feel good or feel bad, depending on your scenario. It's there to assess, are you doing the job that they've hired you to do? And are there any gaps in that need to be corrected? And then we have this thing called segregation of duties, which is CAR, custody of assets, authorization of transactions, recording of transactions. Those should sound really familiar. If they don't, you were sleeping in my AIS class, okay? Now, you may encounter scenarios in literature where you see the words or letters ARC. They say that ARC is segregation of duties. That is absolutely wrong. In this class, it's always CAR, custody, authorization, recording. You may say, well, why does custody have to come first, Dr. Barnes? And my answer is, I don't know, but I don't care either, okay? I want it to be CAR, so it's going to be CAR in this course. Because a picture of an arc doesn't make much sense. It's not nearly as hilarious. All right. And anyway, so what is the idea behind segregation of duties? If these three responsibilities exist in one individual, or if any combination of those, two of those, then fraudulent activity can occur. So consider that you're a warehouse worker, okay? You're somebody who actually has access to inventory. So you have the custody function in place. And then you're totally told by your boss, hey, can you log in the receipt of that inventory for me? Can you record this transaction? You could say, all right, I'm going to record this transaction by not recording this transaction and then take actual physical custody of this inventory in my car, all right? And I don't mean that as a pun. Okay, I meant somebody actually putting it inside their trunk of their car. Is that a problem? Yes, because then you just bypass the whole separation of that responsibility that we wanted to have. By having these segregation of duties, we can make sure that stuff like that doesn't occur. And here's a note: when you start reading your activity for our discussion, the case for the discussion on Wednesday, you're going to notice that there was a lot of problems with segregation of duties. They did not really exist. So that's our control activities. Next, we have information and communication. So in order for controls to work, people need to know what the responsibility is. They need to know what it is they're supposed to be doing. So it's all great and well to have controls implemented, but if people don't know how to use the controls, then we have a problem. So information and communication represents the acquisition, use, and sharing of relevant high-quality information from both external and external sources necessary to support the functioning of internal controls. So the first thing to note is that internal communication is obviously really important. If management implements controls, then the people who are responsible for carrying out those controls need to understand what it is that they're specifically supposed to do. But it's also important to note that this is not restricted just to internal communication of information, that we can have external detail as well. The examples that I can talk about are the Lenny's example, the picture of the pizza place with the A in the window. There's a picture of that A grade right there. Or even further back, if you remember back at the beginning of the semester, we talked about my sneeze burger example. Remember that? Okay. I go and have my cheeseburger. By the way, I had a cheeseburger yesterday. That's why I'm in such a good mood. Okay. But it was not sneezed on to the best of my knowledge. But yeah, you go there and they sneeze on your cheeseburger and like, it doesn't matter if it's delicious or not. This actually affects my decision. That's another aspect of information and communication, both internal and external communication to get feedback for necessary functioning of internal controls. Final component of controls, what is that one? That is monitoring, because as we know, controls change, control risks change over time. Actually, let's evaluate that statement. Do we believe that risks change over time? Do you think that that's a possibility? I mean, I know it was a little while ago, but can we say that organizational risks changed pretty substantially from 2019 to 2020? I don't know why I choose those two particular years. It seems like that's just kind of random. But did anything happen in early 2020 that might have changed the risks for many organizations in the world? Yeah, I'm obviously talking about the pandemic again, okay? When risks change, when circumstances change, an organization has to be able to adapt. That is what monitoring tells us. So we have to assess what controls are in place and whether they are adequately addressing the current risks associated with the organization. If the answer is no, then they need to address that and update that. Here's an interesting example, okay? If I go back 5 years, I could think about essays that were being written at the graduate level or at the undergraduate level in the School of Business. I'd say there's probably some problem with plagiarism, but we have plagiarism checks that are in place right now that we can run those through to avoid that, okay? That's a different risk than exists nowadays with essays. Does everybody understand what I'm talking about with essays? How are essays commonly being generated now? AI tools are large language models, all right, which are not plagiarism because they're generated a unique instance every single time, and they can't really be detected by AI tools, which is interesting because if you go back and use the same mechanisms to try to detect plagiarism or cheating that you used 5 years ago, they will not be effective today. Now, this gets into a slippery slope. It says, well, should we actually be insisting that people don't use AI tools? I'm actually a pretty big proponent for using AI tools. I think that they actually improve things rather than make things worse. That being said, if you talk to another instructor that was going back onto the old paradigm of, yeah, I'm going to insist that nobody uses any outside sources in their writing, they're probably in for a fiasco because there's going to be a lot of students who are going to be saying, ChatGPT, write a 10-page essay for me, go. All right. Yeah. And that's going to be really, really hard to stop something like that. And it's an interesting exercise. We could actually talk about that. How would we address that particular problem? Could we say that we would implement a tool to detect AI writing? Well, if it was an old version of ChatGPT, you might say that's possible because there's certainly certain trends, but newer versions, they don't have the same problems. So is it necessarily effective to use the same protocol and say, yeah, you can't use any tools whatsoever, or should you change your model? Should you change your system to actually accommodate the fact of use of these type new tools? It's an interesting question. It's a lot beyond the scope of what I want to talk about today, but this is the kind of question that we'd ask when we talk about monitoring and updating considerations for new environments. All right. So I want to show you this diagram. I believe I've shown this to you before. So this is a really important one for context of this particular course, and I should have had it opened. I know I've got it here. It is what I call the control sequence. So this is going to be our guide for the course. You may say this looks really familiar. This is actually the image that's on Brightspace right here. Okay, this is the image I use for this course on Brightspace. What is this telling us? Well, we know that controls are responses to risks. That's something we learned back in 367. But it goes beyond that from the perspective of auditors, because auditors need to be able to identify certain things. First of all, we need to be able to identify the risk, which, as we know by now, because we're now 6 weeks into the semester, risks are characterized by management assertions, okay? Wherever an assertion is present, that represents a risk to the organization. So we identify what the risk is and what is the management assertion associated with those risks. I present those kind of next to each other because this is something that they're jointly considered to one another. Once we've identified the risk, we need to say, has the organization implemented a control? They need to have a response to that risk. And so if they don't have a response to the risk, that's a problem already into itself. That's saying that the control is not present. But if a control is present, we still have an additional obligation now as auditors. We have to assess the controls themselves, usually resulting in testing internal controls. And testing controls is consistent with what we talked about in Chapter 5, identifying the assertion, identifying the nature of the control, and seeing if the control does what it's supposed to do. We actually looked at some examples. We're going to look at some examples already. We're going to have some homework that will look at a much more detailed example of testing controls. It sounds like it's really difficult, but it's not. It's just effectively answering a yes or no question. Is the control effective? Yes or no? Now, the process by which you do that will change in different scenarios, but we'll get some exposure to that as we go through this course. I want you to remember this because this is one of the things that I refer back to throughout this course. I think this is a very, very important way of thinking about controls. It doesn't necessarily need to be framed exactly through the way that I put it, but I will use this framework as we go through this course. All right. So how do we actually set up a strategy? Well, there's two approaches to this. Oh, sorry, I forgot I had this slide in here. It's not on my current printed out slide. Summarize. Control environment dictates the organization's overall approach and attitude towards controls. Entity's risk assessment process identifies a risk present organization, control activities, design appropriate controls to address these risks, information communication and monitoring, assure the controls operate effectively. That in a nutshell is what it is. By the way, there's an important distinction and delineation listed there. Remember I said control activities talk about the actual creation of controls. That represents the design component of controls. Whereas information and communication and monitoring talk about the operating effectiveness controls. That ensures that operation is in place. Because there's two ways controls can fail. The first is that they are not present or not designed properly. The second is that they are present and are designed correctly, but people don't pay attention to them. They just don't operate effectively. So you can think about two scenarios. Think about a scenario where you go into an office and you say, all right, how is payroll being processed here? It says, we got one person that does everything. All right. It says, you need to actually have segregation of duties in place to separate the responsibilities out. They do not have segregation of duties currently in place. That would be a deficiency in design because there's no control in place. Then you go and audit another place where they've got 3 people who are responsible for payroll. Each one's taking a separate responsibility, but they regularly ignore those responsibilities and say, you know what? I don't have time to do that today. Can you just do my job for me? That would be an example of a control that is designed properly, but is not operating effectively because people are ignoring it in their intention. So it's an important distinction to make, and we're going to talk about that a lot. We're going to say, is the control present? And if so, is it operating effectively? And those are both criteria that we have to consider as we move forward. All right, so now, there's the control sequence. How about that? Okay. So recall that a preliminary assessment of control risk is developed during risk assessment, okay? Our audit strategy is developed based on our auditor's understanding of reliance of internal controls. Now, I want to make sure that we're very, very clear on something here because this is something that always comes up, and it's very, very critical that you have an understanding of this. We're going to be talking very shortly about scenarios where we do not test controls. And there will be several scenarios where we may say that we can adopt a strategy to not test controls in certain areas, okay? That being said, regardless of what other considerations we have, an auditor always, and when I say always, it must be a very, very certain statement. An auditor always has to develop an understanding of their client's internal controls. Even if they decide not to test internal controls in some areas or many areas, they have to understand the controls that are in place and currently in operation. So understanding controls, 100% required in every scenario. Testing of controls, maybe. We'll talk about why that's the case. So we're going to talk about this thing called audit strategy. And the audit strategy is basically going to be on a 2-point characteristic, okay? So you will look in this diagram and it says right here, does the auditor need to rely on controls? And there's possible 2 answers. There's no or yes, okay? Now, the reliance on controls is going to be dictated by a few things. Probably our most important consideration is, are these controls over financial reporting? And if so, do we need to test them as part of our SOX 404 testing? Because remember, under Sarbanes-Oxley, public companies have to have their internal controls over financial reporting tested. That's going to always be a yes, and we're going to talk about that in a second. But what about scenarios where we say, we don't think that it would be very useful for us to test controls in this area? That is where we're going to say we're going to go with a different strategy. So we're going to talk about that first. This strategy is called a substantive strategy. And basically what it means is the auditor is going to rely on substantive tests to gain all of their assurance. Remember, we actually say we're going to test controls and we get some assurance from there, and then whatever assurance remaining, we get substantive test. What if we just don't test controls altogether? Is it possible that we can get more assurance in the substantive phase to actually get them any assurance we need? Certainly. Usually that will require more work during substantive testing, but it's certainly possible to do so. All right. So auditors decided not to rely on any of these controls and use substantive procedures as the main source of evidence about the assertions controls. Now, as I said before, a substantive strategy still requires that an auditor has sufficient understanding of internal controls. Now, this question has come up in the past, and I want to go ahead and make sure that we're clear about this. A substantive strategy can be applied to the entire audit. If we're talking about a very small organization that does not have a good control structure, we could say we're just going to rely on substantive tests and do no test of controls. More commonly, it's going to be applied to a specific account or business process or for certain assertions. So that does not mean that the entire audit either has to be a substantive strategy or a not substantive strategy, which we'll talk about in a second. It means that we can use a substantive strategy for the entire audit or for part of the audit. We have the ability to be flexible in that regard. So what are the situations we might want to follow a substantive strategy? Well, what if the implemented controls do not pertain to the assertion the auditor is considering? So I go to revenue and I say, I'm really concerned about the existence of revenue in this organization. And then I look at the controls in place and they've got a bunch of completeness and valuation allocation accuracy controls, but not one that actually relates to existence occurrence. Probably doesn't make any sense for me to test those controls because I'm not as concerned about those assertions as I am about existence occurrence. All right. Now that's a kind of a wild example because we're going to be concerned about all assertions with revenue. But if I'm primarily concerned about existence occurrence, I want controls that relate to that particular assertion. What if the implemented controls are assessed as ineffective? All right. So they say, hey, do you have control in this area? It says, yeah, we've actually got a computer for inputs to relate to this control. And I go and look at the computer, and the computer was built in 1946. Okay. It's the original Turing machine. All right. So I'm going to say, yeah, I don't know that I want to rely on this particular piece of technology. I think I'm going to go to more substantive procedures, go to actually the testing of the balances themselves instead of relying on the controls that are in place, because I don't think that this machine, I'm surprised that it actually still works. Okay. Yeah. Or testing the operating effectiveness controls would be inefficient. This one's going to be the one most common we run into, and we're going to see a lot of examples of this later on in the course. Easy example, okay? So I decide, I'm asked by my senior auditor, senior accountant, I want you to, senior associate, I don't know why I'm struggling with that. Senior associate, please go and test debt, long-term debt. And so I see that there's 20 controls surrounding the purchases and the issuance of long-term debt. And I say, all right, how many long-term debt transactions were there for the year? And they say 1. Which would you rather test, 20 controls or 1 transaction? I'm gonna say 1 transaction, just me, okay? I like less work, okay? There's no point in testing all the controls surrounding something if we can just test a single transaction and get our assurance that way. That's oftentimes what we're gonna say that would be inefficient to test the controls if the number of controls is greater than the work of testing the controls would be greater than testing all the transactions, which can come up particularly for those really big accounts with minimal transaction activity. So if we're not relying on controls in this strategy, then the other strategy is probably one where we are going to rely on controls. Hence, it's going to be called a reliance strategy. This is a scenario where we say, we're going to rely on the client's internal controls to at least some degree to gain some assurance over the audit. Now note, if we decide that we're going to set control risk at a level less than high, we want to set a control risk at a level less than high, we must use a reliance strategy, which makes perfect sense because remember, control risk is how we assess the controls in place in an organization. If we don't test those controls, then we can't set that control risk at anything less than high because we don't know anything about the controls. So if we go substantive strategy, by default, control risk will always be high. Okay. To go less than high, we have to use a reliance strategy. So the auditor plans to perform test controls and uses the test results to determine the achieved level of control risk. So we assess control risk, we test controls, then we say, all right, based on our results of our testing, the actual level of control risk is, drum roll, result. Okay, that's our achieved level of control risk. That's what we believe it to be after the results of our test. Now, it's important to note that the test results indicate that achieved level of control risk is higher than planned. The auditor will normally increase the planned substantive procedures. So what does that mean? Well, we assess control risk initially. We say we risk assessment. We say this is what we believe control risk will be. Then once we test controls, we can determine what we believe that actual level of control risk should be, what that achieved level of control risk is. And we can change the nature of our substantive procedures based on that. So say I believe, all right, these controls look okay, but not great. All right. I believe that it's going to be a moderate control risk. And then I go and test controls and they're actually fantastic. I didn't see what the controls were, but I say, wow, these controls are much better than I thought they would be. I'm going to set control risk at low. What does that mean for our substantive procedures? It means that detection risk goes up, substantive procedures go down. I have to do less work because the controls are more effective than I originally thought. More likely scenario, unfortunately, this is the more likely scenario. I look at the controls and say, these controls are probably pretty good. I'm going to set moderate. And then I go test the controls and they're awful. Okay. The controls don't do what I thought they would do. So then I say, control risk is high, detection risk is low. I'm working some late nights. Yeah, that's the unfortunate scenario that we usually run into. Okay. That's what we would encounter. We're talking about reliance strategy. Now, oh, sorry, and I got a little bit ahead of myself. So the control risk to support the plan level of control risk, no revisions to the plan substantive procedures are required. So basically that means if we assess control risk and then our testing reveals that it's exactly what we thought it was, then we don't have to adjust our substantive procedures at all. So that's the other possible scenario. All right. Audit standards require the auditor to obtain an understanding of each of the 5 components of internal control in order to plan the audit. Why? Well, there's a few reasons. First of all, to identify the types of potential misstatement. Keep in mind that controls, as I've said many times before, represent a response to a risk. The risks that we're primarily concerned with in a financial statement audit are risks that would create material misstatements in the financial statements. So if we know what the risks are, we can identify these sources of misstatement that are relevant to a financial statement audit. We also can pinpoint the factors that affect the risk of material misstatement. So risk of material misstatement is a combination of inherent risk and control risk. By understanding the nature of controls, we can identify what risks are present after all controls have been accounted for. Then finally, we can design test of controls and substantive procedures. If we have good test of controls, hopefully we get enough assurance that we can reduce the amount of substantive procedures we have to perform later on. That is the goal. That is the hope. The test of controls will pair out and will actually lead us to do very little work during substantive procedures. By the way, this question may come up. I've seen it actually been on the CPA exam, and I think maybe there's a question of it in the book. The question is, if test of controls come up and the test of controls say, all right, these are the best controls that have ever existed, does that mean that we can completely eliminate substantive procedures? No, even though we get a lot of assurance from controls, keep in mind that controls still only represent transactions and events. They only relate to transactions and events. So anything that flows through the accounting system, any transactions or events that occur over a periodic basis are going to be affected by controls. We still have a responsibility as auditors to ensure that the account balances, the information that's in the financial statements, are presented correctly and are accurate. Okay, so we still have to test account balances, mean that at the very minimum, we do have to do some substantive procedures. Even if the controls are the best controls that have ever existed, we cannot completely eliminate substantive procedures. It's just not possible. All right, my favorite part of the entire lecture, my favorite part, because it's a great lecture because it's controls, and I see the enthusiasm in your eyes. But so we're going to talk about my favorite part of the lecture. We're going to talk about limitations of controls. So controls are great. Controls are not perfect. And basically what we're going to identify is that there are certain factors that can limit the control's ability to work effectively. Some of these are very obvious, all right? Some of these are very obvious. One of the most obvious ones is going to be management's override of internal control. So there's a control in place that prevents management from doing, or that prevents something from happening, but management has the ability to override the control. We should just get rid of management's ability to override controls, correct? That sounds like a nefarious thing. If management can override controls, what's the point? What's the point of having controls if management can override? All right, simple scenario. Let's say you go to Taco Bell, okay? Because Taco Bell is delicious. At least, that's what a lot of people in this room believe. You go and order your meal. All right. It's we'll say $5.48, and you hand them a $20 bill because you're a big spender. All right. And so you're supposed to get $14.52 back, $5.48. Yeah, $14.52. So they take your $20 bill, put it in the register, and close the register. What's going to happen? They should say, "Oh, well, okay. I just got a $20 meal, I guess." They're gonna say, "Wait a minute, you owe me some change." All right. And the cashier is gonna say, I forgot to give that to you. I'm sorry about that, but I can only open the register when there's a transaction, and there's no transaction right now, so I can't give you your change. So you're just gonna accept that? Just gonna go walk off and say, "Well, I really needed that extra $14.52. I had to bribe Dr. Barnes for the next exam." No. So by the way, that's not nearly enough to bribe me on an exam. Yeah. So what's going on? So you're gonna say, "I want my change back." And what are they going to do? They're going to say, "Hey, manager, can you unlock the cash register so I can give this person their change?" Does that sound reasonable? Does that sound like a necessary override of internal controls by management? So management override of internal controls is necessary. But by the virtue of the fact that it exists means that we do have a risk to internal controls that we cannot stop, okay? We do have to have management be able to correct problems that occur because, sometimes we need our change back from Taco Bell, but we have to be aware that this creates a threat that we cannot necessarily address. All right, personnel errors or mistakes. Mistakes happen, and those are things that we can't correct. And oftentimes, frequent situations, we can't create controls that can address those. Now, keep in mind, we do have some controls that can stop mistakes. Like, say, for example, you're typing in a check, okay, you're trying to issue a check, okay, it's supposed to be for $100, but you assume that the decimal point is not automatically in there, so you type in 4 zeros, 100 and 2 zeros for the decimal point, and you try to issue a $10,000 check. And the company says, "Hey, you can't issue transactions more than $500. You have to have authorization." That was a mistake, but it was caught by the system. So some mistakes can be stopped by good internal controls. Some mistakes have not. Has anybody heard about the McMillions series that was on HBO for a little while back? It was about four or 5 years ago. So McDonald's Monopoly, if you heard of that, the game. So they had that going on, and this was like a big thing when I was a kid. I was like, "I'm gonna be a millionaire." I had zero chance of being a millionaire at McDonald's Monopoly. You know why? Because all of the winners for a 17-year period were predetermined. There was actually one security person who was responsible for determining all the winners. They actually worked with the mafia and found it. So what was the source of all this? So McDonald's had this incredible series of segregation of duties in place where they basically said, "All right, we've got the prize pieces. These are going to be held by a security official, but the security official, even though they have custody over the security pieces, it's going to be in an envelope that they can't open because it's actually got to have this seal that can't be replicated, okay? That's the seal that if it cracked, then we immediately validate. So imagine an envelope that's got a seal on it. If that envelope seal is broken, then they're going to say, "Okay, there's security's been breached. We can't issue these pieces. There's a problem." Okay. So basically they've got a nice control over it because one person's got custody, but the authorization function is this seal. What happened is the company that was responsible for creating the seals, instead of mailing the seals to the company, they mailed it to the security officer. So that guy, he basically broke the seal, took out the winning game pieces, replaced them with a whole bunch of duds, and then resealed the envelope with the seals that he should not have ever received. It was a complete and total mistake. It was an accident. He should have never received that, but it led to this massive fraud that occurred over a 17-year period. So does everybody see the problem with mistakes? They do happen, and to the best of our designs, we can't control for every possible mistake that could be in place. All right, my favorite one, collusion, okay? Collusion. So one problem with any good set of controls is that if people who have responsibilities in certain areas are working together, they can collude to bypass controls, okay? So let's say that we're just going to say that you all decide that you're going to kind of get me good for the next exam, okay? So we're going to say that the next exam you're thinking that I'm being really unfair in the questions that I'm asking. It's like, okay, the only responsibility is to cheat, but I've got such incredible internal controls that you're not sure how you're going to cheat, okay? So then Hudson and Brett come up with this great idea. Says, you know what? If one of us asks him a question that takes all of his attention, the other one can look up notes while they're doing it. Okay. So Hudson raises his hand and say, Dr. Barnes, I need you to clarify something. And while he's doing that, Brett pulls out his notes and it's like, okay. All right, I got the answer. Puts the notes away. And then Hudson's like, okay, that's good, Dr. Barnes. I've got it now. And then Brett reciprocates. So Dr. Barnes, now I have a question. It's like, oh my gosh, so many questions. And then Hudson pulls out his notes. Okay. So now they're collaborating. Now, you see the problem here is that I've got a control that's effective that I put in place, but their actions are completely bypassing it, okay? Same holds true in an organization. If we separate out the responsibilities of custody, authorization, recording, what prevents those three people with those responsibilities from working together committing fraud? Answer is, well, hopefully the threat of prosecution, but truly the answer is nothing, okay? If people are intended to work together to bypass controls, they can do so, and controls cannot prevent that from happening. So these are three really important scenarios that we can talk about with respect to controls. I think controls are really important to understand and really important to appreciate, but they are not the end all be all. So be able to understand what possible scenarios can arise from that is really important so that we can design the best possible controls we can and address any failures that might necessarily come up. Just a quick note. Oh, I don't know why I've got, oh yeah, cube collusion. Yeah, okay. I'm not sure why I put that image in there. There we go. Anyway, I think I actually had an old image in there and then I tried to limit that. So there's kind of an interesting diagram to kind of figure out. This is a primary control weaknesses observed by certified fraud examiners. And the answer is that when we talk about internal control weaknesses, it's usually not any of those issues we described above. In about a third of the scenarios, all right, just lack of controls being in place is what we encounter. So remember that design aspect we talked about. Are the controls present? That's the very first question we should be asking. Should be making sure that if there's a risk, that there's a control that addresses that particular problem. From that point, a really large amount of that, the next that accounts for 50% is going to be overriding of existing controls. Okay, so override certainly is a problem, but our primary concern is going to be in 1/3 of our scenarios, is there control at all? And if the case is no, that's where we step in as auditors and try to address the problem. Now we've got more to talk about with controls, but that's all I've got for today. So I'm going to let you guys go and I will see you all on Wednesday.